And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show at 6:06 on this Wednesday as we kind of get midweek underway, get ready to wrap up into the last half of the week already. I don't know where this week's gone to already, just flying by. Of course, we're right in the midst of earnings season right now, and of course that has been really kind of driving markets here over the course of the last few days in particular. Of course, as we got earnings coming in, that's been great. Yesterday, of course, was the first official trading day of the first issued Bitcoin future ETF. I mean, if that's not a mouthful, I don't know what it is, but this is a ETF, an exchange traded fund that trades, that's comprised of futures on Bitcoin, not Bitcoin itself. So yesterday it traded very well. Yesterday, lots of excitement about people wanting to buy into a Bitcoin future ETF. So BITO is that symbol. So if you're interested in looking it up yesterday, actually performance pretty good for the first day. ProShares has to be very happy about it. They did $1 billion worth of volume in one day. That means $500 million worth of buys and $500 million worth of sales all in one day. Not bad. So you did a lot of volume yesterday in the ETF issuance. So again, did well. And of course, that has also been helping lift Bitcoin prices. Bitcoin right here near a record, of course, at $63,000. It's down. I'm looking at the screen right now. It's going to be down about 0.25% this morning after a big run yesterday. So again, not surprising there again, as people are kind of excited about this whole idea. Of course, this opens up the floodgates now for just a plethora of issuers to come out and start issuing Bitcoin ETFs. So we're going to have way more Bitcoin future ETF contracts out there than there is actually Bitcoin. So you know, the issue is going to be ultimately someday if somebody wants to collect. That's going to be the real question. Yesterday, Riot Blockchain, they also announced that they're opening the world's largest Bitcoin liquefied, cooled mining plant on the planet. They're going to increase mining for Bitcoin to a whole new level. And this is interesting because China has completely shut down all of their Bitcoin mining at this point. So in China, all the Bitcoin mining, they were the leader in mining Bitcoins. Now that mining has come home to the United States. The United States will now be the #1 miner of Bitcoin in the world. And of course, the problem with all this is that it's very energy intensive. It requires a lot of electricity to mine for Bitcoin. And of course, the more computer processors that you have doing it, the better your chances of hashing into the Bitcoin and collecting Bitcoin is. So again, it takes just a tremendous amount of energy. Of course, this is problematic for those trying to battle climate change, because that electricity doesn't come from solar and wind. It's mostly coming from coal. So, it's not necessarily, environmentally friendly to mine for Bitcoin, but the U.S. has now gone back into the lead for mining for Bitcoin. So there you go. U.S. is now #1 in something.
So if the lights dim at your house,
exactly,
you know what's happening next door.
If you live close to Riot and you have an electricity problem, it's their fault. So anyway, just interesting stories that are out there this morning. A couple other things going on. Supply chain disruptions. This is going to be kind of the story. Not just now, but going into 2023 and 2024. That's right. Doesn't look like we're going to solve these supply chain problems anytime soon here. We're going to talk about that after the break, because it was an interesting conversation last night with my two high school teenagers. They came home from school, and of course, they were talking about supply chain disruptions in class, and they can't figure out exactly why everything costs so damn much. Well, I'm going to explain to you why we got ourselves into this situation. And it started back today. The problem today started in the late 70s. and we'll talk about why that we are in that position today. So we'll get into this, of course. Very quickly, let's get a review of the markets here because this has been a really good week. 5 days of advance in the markets here so far. The S&P was balancing around support levels, and we were talking about this a couple of weeks ago, holding support here at previous kind of the previous tops going and bottoms going back to July. Held good support there, and we were talking about the market needed to get above the 100-day moving average in order for this market to make an advance higher. Well, it did that, has broken through the 50-day moving average. Now there's nothing really stopping it to get back to previous all-time highs that we were back at in late August, very early September. Likely will be there in the next few days. Won't be surprising here, of course, to see a bit of a pullback to the 50-day moving average, kind of retest that breakout of resistance. That's going to provide a little bit better support. So again, a little bit of a pullback here, maybe 1% or so in the next few days would not be surprising at all, and actually be a kind of a decent entry point to add some exposure to portfolios here. Again, there's probably not a lot of upside here in the short term, and the reason I say that is that if we go back and look, we talked about when the markets were selling off in October, and we talked about go ahead and adding some exposure portfolios. Why we were buying it was because the market had gotten extremely oversold. In fact, hadn't been this oversold really since October, November of 2020. So again, markets gotten very oversold on a short-term basis. Well, that oversold condition has now been almost completely reversed. So there's not a lot of upside here in the markets short-term. So again, a bit of a pullback wouldn't be surprising, but again, the upside is probably somewhere around previous highs, maybe a little bit higher as we get into the end of the year. But again, a lot of that kind of low-hanging fruit, that rally off those kind of correctional lows that we saw last month, likely probably behind us at this point. And again, as we get into the next couple of months, there are certainly some things to be concerned about as we look at this, because even on a long-term weekly basis, markets are still in a very bullish trend here. Nothing wrong with that at all, but we are about to start talking about tapering the Fed's balance sheet. Inflation is a problem here, and that's becoming more pervasive. We'll talk a little bit about that in a second when we get into the supply chain issue. But these are things that are going to start impeding corporate profit margins, corporate profits themselves, of course, earnings, and economic growth. Yesterday, the Atlanta Fed, now the Atlanta Fed is the division of the Federal Reserve that publishes their real-time economic tracking. That number was at 6.5% economic growth at the beginning of this quarter. Yesterday, their estimate for Q3 is now down to just 0.5%, 0.5%. Economic growth has completely collapsed here over the last few months. And expectations, and the reason this is important is because expectations for the fourth quarter are still very high, expecting 3, 4, 5% growth in the fourth quarter and 4 and 5% growth in 2022. And right now, because of lack of liquidity from fiscal policy, right, there's just no fiscal policy. And in fact, as we talk about the infrastructure bills, the likelihoods of that getting passed anytime soon, those lights are starting to dim pretty quickly. The size of the $3.5 trillion package has now been revised down to $2 trillion and will probably be around $1.5 trillion if that even gets passed. So again, a lot of this fiscal policy that people are kind of banking on to help support economic growth is really starting to fade off here pretty quick. So again, that's going to put markets at risk as we get later into this year and particularly into 2022. So again, while we have this nice rally going on, possibly getting us back to all-time highs, might be a good idea at that point to also be adjusting the risk that you're taking in your portfolio as well. I'm your host, Lance Roberts. Be right back after the break. We'll talk about supply chain disruptions and why it started back in the 70s. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
October means it's time to fill out the infamous FAFSA form for college financial aid. Don't make mistakes that can cost you money. Our next virtual Lunch and Learn will show you how to maximize your free application for financial student aid, the FAFSA. Register now for this free Lunch and Learn with Danny Ratliff and Chris Lebo, Thursday, October 28th at noon at realinvestmentadvice.com. Filling out the FAFSA is vital for getting financial aid. Learn how. Register now at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Good morning. Welcome back to the show. It's 6:17 as we kind of get things underway. So talking about supply chain disruptions was interesting because last night I was, at home. I was kind of cooking dinner and both my teenagers came downstairs. They actually left their room. Apparently they heard the dishes clinking in the kitchen and food being prepared. So that was their signal to come out of their cave. But we kind of got set down and, I was still cooking dinner and, they were kind of talking with each other. And my daughter said, I tell you, it is crazy what's going on, with the government right now. And I'm like, well, what are you talking about? And she's like, well, I'm taking government in school. And I'm like, okay, this is going to be interesting. I go, well, what are they teaching you in government? And it's like, well, I went and filled up my car today and it was like $50 to fill up my car. It's ridiculous. And inflation is just crazy. And I'm like, yeah, it's a problem right now. Prices are going up everywhere. And I said, but why are prices going up everywhere? And I go, this is going to be good. Right. She says, well, I don't know why they're going up. They're just going up. And it's just crazy how much stuff costs. And then, of course, my son has to chime in as well. And they were both complaining about the high cost of living because, again, and I kind of chuckled myself because, they still don't have to pay rent, but they do have to pay for their own gas. They pay for their insurance. They have to pay for all their food that they want to go run around and do with their friends. I don't support any of that. They need to learn to be adults. So they're learning to be adults, but they're also learning these valuable lessons of how far hard-earned money will go in this economy, right? And it doesn't go very far. By the time they fill up their gas tanks, pay their car note, pay their insurance costs, and then, go out to eat with their friends a couple of times, not a lot left over from their job. Now, they make fairly decent money, right? So they both work for a restaurant, and they make probably somewhere close to $15 an hour at the restaurant. So, it's, they're making okay money for their age, but again, it doesn't go very far. And so we got to talking. So I asked him again, I said, so why is it that we have these, these higher prices? And my daughter finally pops up with the right answer. And she's like, well, it's because of all these supply chain disruptions that we've got going on. I go, exactly. I said, now, why is it, though, that inflation goes up? And my son pops up with the right answer. He says, it's supply and demand. I go, you are absolutely right. I said, y'all did pay attention in class. This is awesome. I said, so what's the problem? Why do we have too little supply and too much demand? And they did not know the answer. The answer, and most people don't know the answer, is not because of supply chain disruptions. That's the resultant cause of something that we started back in the late 70s. And you had to actually be in class back in the late 70s and study this in economics back in the 70s and 80s, because I don't think they actually teach this anymore. But back then, U.S. companies decided that it would be a really good idea to emulate a Japanese form of inventory management called just-in-time delivery. And the difference is that in the U.S. at the time, what we would do is we would manufacture a bunch of stuff and we'd put it up on a shelf and we'd maintain fairly high levels of inventory. And this allowed us to meet demand when it came. So somebody wants to order a widget. I've got plenty of widgets on my shelf because I've been producing them like crazy. And I can make delivery. And of course, back then when I had to deliver something, it took, a couple of weeks. I had to put it on a truck or whatever, put it in the mail, whatever it was. And it took some time to get there. So having excess inventory was always important back then. But U.S. companies said, you know what? If we can reduce the amount of inventory that we maintain, it'll make us more profitable. And so we began this process of adopting this just-in-time delivery. And of course, as the speed of delivery has been improving over the last several decades, of course, we started with FedEx, excuse me, back in the 80s. And when FedEx came around, it was like, well, this is crazy. Who needs stuff overnight? That's ridiculous. Of course, today, people don't know what to do if they can't get stuff overnight. It's like, oh my gosh, I've got to wait 2 days to get it? That's ridiculous. I got to have it now, right? So we have this whole immediacy thing. So just-in-time delivery became much more effective because we could literally manufacture something on the spot. Order comes in, we can manufacture on the spot and ship it out to the customer and really maintain very little inventory. So my inventory cost really fell a lot. And this really helped boost profitability. Of course, lower interest rates, lower rates of inflation, consumers going into a massive amount of debt to buy more stuff that they don't really need, all really help boost corporate profitability over the course of the last 3-4 decades. And it's all worked fine and dandy. Just-in-time delivery works great until you wind up with a problem. And that problem, of course, nobody ever anticipated or planned on shutting down an economy. I mean, that was never even in, nowhere in the history book was there ever a precedent where somebody says, let's just shut down the economy and stop all activity for a cold. And that's what we did. And now all of a sudden, though, there's no inventory. And at the same time that there's no inventory on the shelves because we do just-in-time delivery, we give people $5 trillion to spend in the genius of government. And of course, nobody thought for a second and said, okay, look, if I give people a whole bunch of money to spend, this is going to be great because they're going to go out and spend it. The problem is there is literally no inventory for them to buy. And because we've shut everything down now, companies can't produce anything. Now the problem is that you have, and again, as my kids were talking about last night, you have a supply-demand problem. And this is why you have inflation. When there's too much demand and too little supply, prices go up for whatever scarcity of item there is available to buy. So prices are going up. Food costs, energy costs, you name it. It's all going up. And because we have a massive amount of artificial demand that was generated by all the liquidity that was pumped directly into the system, that's still working through the system. It has not completely finished yet. So we're keeping the demand rather elevated. If you take a look at retail sales, et cetera, it shows you that. We're well above what the trend of the economy can actually support. And that's because of that excess liquidity that's in the system, and people are buying stuff with it, and they're doing exactly what they're supposed to. But that demand is going to fade, and it will fade fairly sharply as we get into 2022. That will take some of the pressure off of companies who are now working as fast as they can to produce inventory. And what will happen now is that we will have a swing in the pendulum from a supply chain disruption to a supply chain glut as we get into the next couple of years. Now, it's not going to happen overnight. It's going to take some time, but companies will keep producing now at the current rate because what happens with companies is they begin to expect that the current level of demand is going to remain permanent. So they will keep producing at the current level, expecting the current level of demand to remain. And as the current level of demand begins to fade, they will wind up overproducing inventory. And inventory will slide in the other direction, and we will eventually have deflationary pressures in the economy rather than inflationary. Now, it's going to take some time. It's not going to happen overnight. It's not going to happen next week, next month, next year. It's going to be a while. But probably sometime in late 2022, early 2023, somewhere in there, we'll probably start to see the initial effects of a more deflationary bend in the economy as the supply chain cycle swings in the other direction. Look, everything, and this is one of the problems with this kind of panic around, oh my gosh, inflation's here, it's going to be the 70s, it's going to last forever. Even the inflation in the 70s didn't last forever. It lasted for a while. But eventually, all of these things do cycle back in the other direction. So it's going to be problematic here for a while. And this is one of the big risks for the Federal Reserve, is that if they began to hike interest rates in anticipation, and the Fed looks at about 5 different measures of inflation. They look at their trimmed personal consumption expenditures. They look at CPI. They look at all of it. They have 5 different measures, roughly, they look at in terms of inflation. All those are telling them that there is sufficient in inflation in the economy for them to start hiking rates. And that's true, there is. And they should. They should have been hiking rates in probably fourth quarter of last year. Once the economy started getting back on track, they should have started hiking rates, reducing their balance sheet, slowing the input into the economy to allow the economy just to stabilize. But they're always late. And now what they're going to start to do is hike interest rates right at the time that we will swing the other direction on the supply chain disruption plan. And it's going to be an issue. And the economy is going to slow a lot faster than what people expect. So the big risk for a recession is probably late 2022, early 2023, somewhere around there, as this all swings in the other direction. It's also going to be problematic for corporate earnings and for stock prices. But again, timing of this is very difficult because you don't know when this swing in the pendulum will occur, but it will occur. And it's a function that, because of this just-in-time delivery that we started back transitioning to in the early 80s, has now found the fly in the ointment, so to speak, in terms of what happens when you can't produce supply and you've got excess demand from artificial influences. That's what we're finding out now, and it'll be interesting to see just how companies change for the future. Be right back after the break.
The Real Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
October means it's time to fill out the infamous FAFSA form for college financial aid. Don't make mistakes that can cost you money. Our next virtual Lunch and Learn will show you how to maximize your free application for financial student aid, the FAFSA. Register now for this free Lunch and Learn with Danny Ratliff and Chris Lebook, Thursday, October 28th at noon at realinvestmentadvice.com. Filling out the FAFSA is vital for getting financial aid. Learn how. Register now at realinvestmentadvice.com. Realinvestmentadvice.com.
Have the market's gyrations made you nervous? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. We do that by having both a buy and sell discipline. Does your advisor do that? If you think it's time to work with an advisor who puts your interests first, it's time for real investment advice. RIA Advisors, 855-RIA-PLAN. RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
We have a lot of vultures out in Katy, Texas. I don't know why.
Lots of carrion.
Probably so. So anyway, there's one of the largest vultures I've ever seen. It could have been a turkey for all it was that big. But it's standing on the street corner. All the traffic stopped and the bird walks across the entire four-way intersection to the other side. I'm like, God gave you wings.
He's been watching the panhandlers.
I guess
The
so.
Real Investment Show podcast
Got a dead rat in your car? Throw it out.
at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows. Subscribe and bookmark our YouTube channel for The Real Investment Show. Or just click on the show links at realinvestmentadvice.com. Realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the show this morning on this Wednesday as we kind of get the, world moving into the end of the month already. And the number of people saying that they are going to celebrate Halloween this year is back to partying like it's 2019 again. People are going to go out, they're going to dress up, and they're going to go door-to-door trick-or-treating, and they're going to be wearing all their masks. It's going to be fantastic, so everybody be compliant. So I'm just wondering how many people are going to dress up as the COVID-19 virus this year.
Ooh,
I wonder how many costumes are getting sold for that.
I'm going to be a protein spike.
Very good. We'll see. This is going to be interesting. So, of course, this is my favorite time of the year because this is when we go buy lots of candy, because we're always on diets in our house. So This is a good time of the year. We go buy lots of candy. We shut off the porch light to celebrate Halloween.
Now, does your bride go in the day after Halloween and get it for half price?
No, she is not a discount shopper.
Oh, okay.
for Halloween candy. It defeats the whole purpose. We don't really want the candy in the house, right?
Right.
We just use the Halloween excuse to have Reese's in the house. Because
I don't need an excuse for Reese's.
I know you don't, but I do, right? So we're always on diets, so we have to have a reason to have Reese's peanut butter cups in the house, and this is it. So you can't buy it after Halloween because there's no excuse. There's no excuse, right? Exactly. That's the point. But she was very upset yesterday.
Why?
Bill, I told you the story a couple of weeks ago about my wife. She wanted to, here it is, the beginning of October. She wanted to put up the Christmas trees, and I wouldn't let her, and she was very upset.
Yes.
And so we compromised on putting Thanksgiving stuff on the table and Halloween stuff in the living room, right? So that was our grand compromise. And she has literally got a calendar on our refrigerator marking off the days until November the 1st so she can put her Christmas trees up. This is getting a bit crazy around our house, but we're getting there. But she was so ticked off yesterday.
What did you do?
I didn't do anything.
Why was she ticked?
Which is not usually the case, by the way. It's usually me doing something. My neighbor put up his Christmas lights on his house.
Oh, isn't there a law against that?
Well, now I'm having to combat him with my wife wanting to put up Christmas trees.
Yeah.
She's like, well, he put up Christmas lights. I'm like, well, I'm still not letting you put up Christmas trees yet. So
There's nothing worse than neighborhood peer pressure.
exactly. So next couple of weeks, you're just going to be miserable until after Halloween. But thank goodness. We're almost there.
So she hasn't discovered the orange lights for Halloween
Would you
decoration?
stop? She listens to the show on her drive in.
No, she's not listening.
She listens now because she works upstairs from me. She literally, her office is right over our studio now. So she listens on the way in now. Don't help me out.
Okay. I'll cut that out.
Cut that out, yes. Anyway, a couple of things talking about the markets. There's interesting kind of things. There's a few interesting things that are going on right now, I think, that are worth, kind of looking at. And I've got a chart this morning on the outlook on bonds. I put this out on Twitter this morning, and they often say that people don't ring a bell in the markets. And one of the things that we've heard a lot about lately is oh my gosh, interest rates are about to go through the roof because of inflation. Well, not really the case. Yes, we have inflation, as we were talking about the last segment. We do have inflation occurring because of supply chain disruptions, all this liquidity pumped into the market, et cetera. So it's all leading to short-term inflationary pressures. Not surprisingly, that has led to a very negative sentiment on bonds. Nobody wants to own bonds because inflation is going up. So that must mean interest rates are going to go up. Yet interest rates really aren't rising that much. We're about 1.5%, 1.6% right now on the 10-year Treasury. Now, the very short end of the curve, those bonds, the 2-year, the 1-year, the 3-month bills, those rates are going up because the Fed's getting ready to hike rates, and that's what that end of the bond market is telling you. But that's creating what we call a flatter, I should say, yield curve. In other words, shorter end rates are coming up, but longer end rates really aren't moving much. But as I said, one thing that you can count on more often than not is that when Wall Street gets all on kind of one side of the trade, whatever that trade is, they're generally wrong. There's an old saying by Bob Farrell, one of his famous rules is that when all experts agree, something else tends to happen. And that's very much the case, and particularly when it comes to yields. In fact, when you take a look at the outlook for bonds right now, it is the most negative that we've had since the turn of the century. Previous periods of high negativity were July of 2007. Nobody wanted to own bonds because we had this booming economy and everything was fantastic and inflation was coming up and the Fed was going to have to start hiking rates potentially, but it was no big deal, no big concern. And of course, if you were buying bonds in July of 2007 and selling your equities, you would have survived the 2008 meltdown very well. In February of 2011, outlook on bonds was very negative. And of course, if you would have held on to your bonds at that point or bought bonds, you actually did very well going into 2012 as we got into the debt ceiling debate. Market declined 20%. Bond yields fell to record lows at the time. Again in 2013, same thing. Got into the Euro crisis. Bonds did very well. February of 2018, as Donald Trump was talking about the trade war. And of course, going into the end of 2018, the market declines by 20%, yields fall to a record low. And then October 2021, we're now at negative record sentiment on bonds. My point is that every time throughout the last 20 years that the market has gotten very negative on bonds, it's been a great buying opportunity to add fixed income to your portfolio. Now, we're talking about specifically the longer end of the curve, the 10-year, 20-year, 30-year treasury at this point. Not corporates, not about treasuries. But to hedge your portfolio, what this is telling you is there is risk in the markets right now, and the markets aren't picking it up at this point because despite the fact that there's inflationary pressures right now, that is not only just a issue economically speaking. In other words, it slows economic growth. And again, we're looking at economic growth contracting very rapidly here. But equities are extremely overvalued. Earnings are at risk if we do have slower economic growth because there's a high correlation between economic growth and earnings. And yes, while earnings appear to be doing fairly well right now, this is still kind of the wrapping up of the post-pandemic shutdown, $5 trillion of injection liquidity into the market earnings boost that we got. That's all going to fade heading into next quarter. Year-over-year comparisons are now very tough going forward. So earnings growth is going to be much more challenging over the next few quarters, and with valuations very high, this becomes much more problematic. So what bonds are telling you at this point is that there's something not quite right in the markets because and here's the thing, and we've talked about this before. People go, well, bonds are overvalued. Bonds cannot be overvalued. Bonds cannot be overvalued. And here's why. If I go to buy a bond today, I am paying a price for that bond and I get an equivalent yield based on the price that I'm paying. That yield is what I'm going to receive between today and the maturity of that bond. So as an investor, I have to account for inflation risk, credit risk, default risk, all these various risks of making that investment into a bond. And my yield has to justify all those risks that I'm taking. It's particularly the case if I'm issuing debt or if I'm a lender and I'm going to loan somebody some money. So it's Brent has a company, he wants to borrow money from me. He comes to me and says, Lance, I want to borrow some money. I go, great. I'm going to charge you 3% on this loan or whatever the number is. Well, that rate has to compensate me for the duration of the loan, 1 year, 3 year, 5 years, 10 years, whatever it is. Inflation cost, expenses, all that. I've got to compensate for all those things inside that interest rate that I'm charging for that loan. Otherwise, I lose money. So bonds technically can't be overvalued because they have to reflect all these various risks of me loaning money to somebody at today's rate for whatever the duration of the bond is. Just the way the math works. Now, the big issue here, though, is what the market's telling you is like, oh my gosh, we have all this inflation. Investors are going, well, I don't want to own treasury bonds because interest rates are going to go up because of inflation. Well, what interest rates are telling you is that the inflationary pressures that we have right now are transitory and they will fade at some point in the future. And economic growth is going to slow to somewhere between 1 and 1.5%. So the extreme negativity on bonds right now tells you that there's a very high probability that this is probably one of those points in history where you buy bonds and you actually make more money in those than you actually do in the stock market over the next 24 months. Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
October means it's time to fill out the infamous FAFSA form for college financial aid. Don't make mistakes that can cost you money. Our next virtual lunch and learn will show you how to maximize your free application for financial student aid, the FAFSA. Register now for this free lunch and learn with Danny Ratliff and Chris Lebo, Thursday, October 28th at noon at realinvestmentadvice.com. Filling out the FAFSA is vital for getting financial aid. Learn how. Register now at realinvestmentadvice.com. Realinvestmentadvice.com.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, simply online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Welcome back. It's 6:47. Get ready to wrap up the show this morning. So, the S&P. We talk a lot about corporate share buybacks, and again, there's lots of stuff in the media about how corporate share buybacks are a return of capital to shareholders. No, it's not. And the reason it's not is simply this, is that if a company buys your shares, you've got cash and they've got your shares, right? But you can sell your shares any day of the week on the open market. So it's not returning cash to shareholders. What it does do is provide insiders an ability to liquidate the grants, the equity grants that they're given inside the company. So the people that actually truly benefit from corporate share buybacks are insiders of companies. And look, there's been studies by the Securities and Exchange Commission and other industries that all show the same thing. But, the media likes to run around and go, oh, it's a way to return capital to shareholders. No, it's not, because when Apple says, hey, we're going to buy back shares, they don't call you up and say, hey, Bob, can we buy your shares back? And we'll send you a check for your shares and you send us your capital. That's not the way it works. Dividends are a return of capital to shareholders. Because a company issues a dividend, they take money out of their coffers and they send it to you. That's a return of capital. Share buybacks are not. But they are a huge inside influence for company executives, and this is why executives have gotten extremely rich over the course of the last decade from corporate share buybacks. But here's something else that you need to know about corporate share buybacks. Right now, the S&P is trading right around 4,500 on the S&P. without corporate share buybacks, and there's a great chart out this morning from Pavilion Global Markets that breaks down the composite. It's the decomposition of returns of the S&P 500 based on the multiple, the valuation expansion, right? So people are just willing to pay more for stocks, the earnings per share of these companies, dividends, and buybacks. And what's important to note is that ex buybacks, the market would be right around 2,500 today, not 4,500, which would be much more in line with what you would expect with economic growth around 2% on average, earnings growth, dividends, and valuations, and what we're paying for valuations. So it's certainly far less exuberant, right? You know, if you look at it that way, it's like, wow, so we went from 666 to 2,500 over the last decade. And that's certainly not the rate of return that, you know, I would have gotten otherwise. But and we've written about this before, the amount of influence of stock buybacks on the markets has been a major support. We're going to do roughly $1 trillion worth of stock buybacks. This was in our article yesterday, talking about the kind of the bullish and bearish case of the market. And the big driver of the market is stock buybacks. In fact, in 2017, 2018 in particular, stock buybacks made up almost 100% of the net purchases of the market. So just a massive amount of corporate liquidity being used to buy back shares. And of course, what's the benefit of buying back shares? Well, if I don't have really strong revenue growth, which we don't, and if I really don't have very strong true earnings growth, which we don't, how do I make that appear to be a lot stronger than it actually is? Well, I buy back my shares, because what we do is we adjust the denominator so that our numerator, which is our earnings, divided by our earnings by the number of shares we have outstanding, that's how we get to earnings per share. If I reduce that denominator, it makes my earnings look better. Let me put it this way. A company earns $1 in earnings, and they have 2 shares outstanding. Let's keep math really simple because it's early in the morning. So my earnings per share is 50 cents per share, right? The company and the Wall Street says, well, I think that your company can earn 75 cents a share this quarter. And I'm looking at my books going, I'm going to earn 50 cents a share with my 2 shares outstanding. So what I'll do is I'll buy back 1 share of my stock. Now I've got 1 share outstanding. So now my earnings per share, $1 of earnings for 1 share is $1. And I beat earnings. Did I create any more earnings? No. Did I grow my business? No. Did I become more profitable? On paper. And so that's why companies have been doing this. And in an environment where the economy is growing at roughly 2% or less, there's really no incentive for companies to invest capital into creating more jobs or building out more product plant, taking on more long-term liabilities, doing capital expenditures, these type of things. And this is why all that stuff has remained very weak and has been growing at about the rate of economic growth over the course of the last decade. And we keep scratching our heads going, I can't really figure out why we're not spending more on CapEx. You know, the economy's doing great. You know, the markets are doing awesome. Why aren't companies spending more money? Because, again, there's no value in doing it. The easiest way to create earnings growth that can beat expectations is simply to buy back my shares. It's the least best use of capital, but it's become a major source of earnings growth for companies over the last 5 years in particular. Buybacks weren't such a big issue. They were there, you know, in 2013, 2014, 2015, but they were a very small portion of the overall markets. Today, it's just gotten out of hand. Now, mind you, that stock buybacks were illegal until the 1990s. The Securities and Exchange Commission had outlawed stock buybacks as a form of stock manipulation after the Depression. And, markets traded pretty much on value, give or take, until the 1990s. And then in the 1990s, Bill Clinton comes along and says, we need to fix this executive compensation thing. So we're going to cap executive compensation at $1 million. And Wall Street said, okay, we'll just start using stock options. So they lobbied heavily for the SEC to repeal their rule on stock buybacks. And of course they did. And then later on, that was when, this occurred. And Bill Clinton went after executive compensation, and stock buybacks became the way to compensate corporate executives, because they can pay themselves less in terms of salary and pay themselves a whole lot more in terms of stock options. And then, of course, having the company buy those stock options from them is a very lucrative way to increase your net worth. And that's why, we have corporate executives making, $100 million a year. And we decry this problem, right? We say, oh, it's just terrible. Corporate executives are just making way more than the average worker. It's unfair. With the top 10% own 90% of the stock market. Well, you're looking at the reason why. It's easy to fix. You just outlaw stock buybacks. And now, when you do that, you're going to take away a major support of asset prices, and the market's going to collapse. And it's going to go back down to value of what the actual value of the market can support. But at that point, the market would start to trade on earnings, dividend, and valuations, which is what it should trade on, fundamentally speaking. But see, nobody wants to do that, right? I mean, corporate executives aren't going to vote for it, and they're the ones that contribute the most to political campaigns, so that'll never pass through Congress. And of course, Wall Street controls the SEC, so that'll never happen. But it is worth noting that a big driver of this market ultimately, and probably the driver of the market ultimately, is what's going on with corporate share buybacks. And again, it's the least best use of capital for a company. It has no long-term benefit. It is an immediate gratification. This is simply the same thing as a hit of cocaine, right? You do it, you feel great for a little bit, then you crash. That's all the benefits you get out of a stock buyback. It is not a long-lasting benefit to earnings. Because every quarter we're adjusting expectations of earnings. And so if I buy back a bunch of my shares and I was supposed to report 80 cents a share this quarter, and I report 85 cents a share this quarter because I bought back a bunch of shares, well, next quarter, guess what? It's now 90 cents. I've got to go buy more shares to try to beat that number. It's like that old cocaine commercial where the guy says, I do cocaine so I can work longer, so I can make more money, so I can do more cocaine, so I can work. It's that vicious circle, and that's what happens with share buybacks. It's just a vicious circle. And you got to keep doing it, and this is why it accelerates every quarter. It just keeps getting worse and worse and worse, and we have more and more and more corporate stock buybacks. And the reason is simply because of the fact that you've got to keep doing it in order to beat your earnings. And if you don't do it, you're not going to beat earnings, and then you're going to lose several $1 billion worth of market capitalization. Your stock price is going to go down. All of a sudden, your corporate stock options that you're depending on for your personal net worth aren't worth anything. And that's why we're in this trap. Again, it's an easy fix. The SEC just needs to come back and outlaw those again. They won't. But while we're running around trying to figure out all the problems in the world, this is one of them. Wraps up the show for the day. Get by our website, realinvestmentadvice.com. That's realinvestmentadvice.com. Send your questions, comments, emails. Let us know what we can do for you. As always, we're happy to help. Of course, sign up for our upcoming seminar on FAFSA form. So if you've got a kid in college like me that's getting ready to apply for FAFSA and financial aid, you might want to tune into that webinar. The link is on the website now under our events tab, and right on the homepage, just scroll down to our events. They are all listed there for you that we have coming up all the time here at Real Investment Advice. Have a great day. We'll see you back here for the Thursday edition of the Real Investment Show. See you tomorrow.
Always Sunday in the rich man's world.